So one of the most asked questions that I receive is, how does Social Security get taxed and how will it be taxed in 2022? I'm John Davis. I'm a financial and estate planner and a certified financial fiduciary. I work for a company called America United Wealth Planning. Today we're sharing our knowledge and ideas to make life richer for you and your loved ones. Let's start with a history lesson on taxes and Social Security benefits. From 1937 to 1983, all Social Security benefits were completely tax-free. Nada, not a dollar was paid in taxes. Then in 1983, the tax code was changed to allow up to 50% of your benefit to be taxed. Then 10 years later, the tax code was revised again under the Deficit Reduction Act of 1993. They added in a new tax bracket, and now today up to 85% of your benefit can be taxed. All right, so here's what you have to understand is that today's Social Security is taxed based on what's called a provisional income formula. Okay, the way that this works is that we start with your gross income. That's listed on your tax return. And to that we add in any tax-free interest that you earn. Maybe you earn some interest off of municipal bonds. And then we add in 50% of your combined annual Social Security income. Add all three of those together and it adds up to what this year's provisional income will be for you. Okay, so to simplify this, I want to introduce you to Carol and Bob. Carol's Social Security check is $18,000 per year and Bob's is $18,000. So the total combined is $36,000 per year. Now to compute their provisional income, we take half of their benefits, which is $18,000. We add in Carol's pension, which is $24,000, and we add to that $20,000 that Bob pulls from his IRA. Okay. As you can see, when you total it up, their provisional income would be $62,000. All right, so we computed their provisional income at $62,000. Now here's where people get confused. If you look at the IRS tax chart, you might think that 85% of their provisional income would be taxed, right? It would give them a tax bill of $52,700. But if you did it that way, it would be wrong. That's not how it gets taxed. And in fact, the taxes that you pay on your Social Security are taxed under what they call a progressive tax. So you're saying, well, what's that and how does that work? Well, here's how it works. They'll pay zero on the first $32,000 of earnings. They'll pay 50% on the next $32,000 to $44,000 of earnings. So in this case, we're talking about $12,000. And 50% of $12,000 is $6,000. So their tax bill this year is going to be $6,000 on that portion of their income. Next, 85% on the amount is paid for the amounts earnings of $44,000 and up. Well, in this case, we're talking about $18,000. So if you multiply that $18,000 by 85%, you would see that their tax bill on that amount of money is $15,300. So now, if you add the $15,300 to the $6,000, what you'll see is that they're going to pay $21,300 in taxes on their Social Security income. Okay, so there you have it. 71% of Carol and Bob's income will be taxed at today's tax rates. Now here's the thing, they're going to pay more in future as future tax rates go up. And this is going to shrink their Social Security income in the future. Because of rising taxes, they're going to have less income to spend in the future. And that's a problem. Where do you think future tax rates are going? Do you believe they're going up or that they're going down? Now, when I survey most people, what they'll tell me is tax rates are definitely going up. And if you set up, then you'll pay more in taxes and you'll have less to spend if you don't have a plan to combat it. Okay? Now, most people, it's very interesting that most people work very hard to avoid stock market losses when they're growing their portfolio. But they do nothing to avoid or reduce the taxes that they're going to have to pay in the future. The thing here is that every dollar you pay in taxes is a dollar less that you have to actually spend after you retire. So the question is, when taxes do go up, will you be able to afford the lifestyle that you've come to love in retirement? Now the good news is that it's possible to reduce or possibly create a tax-free retirement if you do some planning today. See, I believe that taxes are going up, and if you agree, then you have to start your planning today before the taxes go up in order to protect your income and preserve your estate tomorrow. Again, I'm John Davis. I'd love to discuss this with you. Contact me at the information on the screen. I'll be glad to schedule an appointment, and we'll share some ideas and kick some ideas around and see if we can reduce your tax bill in the future. Thank you for watching the video. I look forward to talking to you in the future.